Hello and welcome to the Lloyd's List podcast. My name is Joshua Minchin and I'm a reporter here at Lloyd's List. Over the last few weeks, we've brought you several episodes from our experts here at Lloyd's List, briefing you on what to expect in each respective sector in 2025. Well, today, we're rounding off that series with a look at the marine insurance market with our very own insurance editor, David Osler. Now, marine insurance might not dominate the headlines like other sectors do in our industry, but it's arguably one of the most important. It was thrust into the spotlight early this year when the container ship Dali struck the Francis Scott Key Bridge in Baltimore, which tragically resulted in the deaths of 6 construction workers. That casualty could wind up being the costliest in maritime history by the time it's run its course through the US judicial system, and the International Group of P&I clubs is already on the hook for some serious cash, as David has pointed out in his work following the incident this year. To talk you through what fallout you can expect in 2025, as well as rate hikes and the impact of Red Sea rerouting on the insurance markets, here's David Osler. David, thank you so much for joining me. As Lloyd's List's insurance editor and, I must say, all-round marine insurance guru, you're the best possible person to answer this question. What should we be looking out for in the marine insurance sector in 2025?
Well, as you probably know, Josh, there are 3 main classes of marine insurance that we write about in Lloyd's List. The first of them is protection and indemnity, or P&I, provided by the 12 marine mutuals that make up the International Group of P&I clubs. We already know what's happening there because it's all in the open. They declare their pricing beforehand. That's going to get more expensive. I think you're seeing a division now between the stronger clubs with the stronger balance sheets, perhaps in a position to give money back by way of capital distributions, as Steamship Guard and Britannia have done, or freeze prices as ship owners have done. And those clubs that are under a bit more pressure, especially from the ratings agency point of view. I think the panic there was a few years back that a couple of the weaker clubs were perhaps not much longer for this world and would need a lifeboat merger, let's put it charitably, that they would merge and be swallowed up by one of the bigger entities. But I think that panic is off now. Everybody looks at least stable, which is good news for the stability of the insurance system, and that's what we like to hear. On the other hand, the hull and machinery, the other main category of marine insurance bought by ship owners, is going to get cheaper. People will be pleased to hear. Not really a ship owner purchase, as I say, but some Lloyd's List readers will be interested in this. Not least the insurers, not least our readers in the trading houses. That looks to be getting cheaper too, again for similar reasons as to hull and machinery. It's getting cheaper because new capacity has been coming in.
David, I know a lot of our listeners and indeed your readers might already know why, but can you explain why P&I insurance is going up this year? We've seen rate hikes from almost every international group club, haven't we?
Not quite every international group provider. Let's fly the flag for Ship Owners Club here, who have frozen prices this year for the main commercial classes. But you're right, by and large, the increases have ranged between 4% to 7.5%, bunched around 5%. And I think the reasons for that are fairly obvious, and that is that while shipping has been getting safer for decades, when things do go wrong, they can go wrong more badly in this day and age. We are looking at a string of massive casualties this year, which some people are projecting. It's a prediction at this stage because the policy year doesn't end until February the 20th. But the prediction for this policy year is that the deficit will be at an all-time high. It could top $650 million. That's a big hit shared among the international group clubs, and they're going to have to price with that in mind, of course. It's the claims environment is the simple explanation here.
Has the incident in Baltimore had anything to do with that, or have we not really felt the impact of that particular incident yet?
We already have felt the impact, I think. But that doesn't mean to say that we're not going to keep on feeling it for a long time to come. I mean, what we have seen is that the owners of the vessel, the owners and operators, have settled with the US Department of Justice for the expenses involved in sorting out the response to the incident. That settlement was over $100 million. And that we believe, as far as we know, that has been fully funded by international group clubs. That's already exhausted their collective retention and taken it into the deductibles before we hit the reinsurance layer. So that has already been a big hit. Now, the question, of course, that's keeping a lot of people awake at night is how big is the bill going to be ultimately? I mean, that's just the bill for the emergency response, essentially. There are a lot bigger bills to come. That will be decided in the US courts. The owners and operators have filed for limitation of liability under US law. They think that their liability should be capped at $44 million. Needless to say, the Maryland state authorities and the Baltimore city authorities don't see things like that. They think they are entitled to a lot more compensation, including some or all of the cost of a new bridge. Yeah, the claims could go to hundreds of millions of dollars, certainly billions of dollars, possibly, making it the most expensive marine casualty ever. It will be for the Judge James Bredar, I believe he's called, to decide on that. We're not expecting a decision this year, but possibly early next. So, yeah, this one will run for a bit. It's got a few more years to go. It's not going to rock the International Group pool scheme. It should be covered by the reinsurance layer, but even that has meant increased reinsurance bills, especially for box ships.
I also just wanted to bring up a point you made in your marine insurance outlook for the year, which is a cracking read, by the way. And if you haven't read it, that is your homework for after this episode. Reroutings around the Cape of Good Hope look set to continue despite the announcement of a ceasefire between Israel and Hamas last week. How do those reroutings affect marine insurance?
The problem from an insurance point of view with rerouting around the Cape of Good Hope is that weather conditions are rotten, famously, among mariners on that route. A lot of heavy weather, and we have already seen that resulting in a number of quite big claims for box stack collapses and that kind of thing. So, yeah, it's not like the relatively calm trip through the Suez Canal and the Med. You're getting into choppy seas. Obviously, insurance works on the basis of pricing the risk. More risk, higher prices. It's that simple.
David, can you talk to me a bit about capacity? I mean, usually extra capacity is bad for shipping lines, good for shippers. Does that axiom ring true in insurance too? Is extra capacity in the market bad for insurers but good for ship owners?
Very roughly, yes. I think is a straightforward answer to that. If there is more capital seeking to be placed by insurers, then everything else being equal, that will tend to drive down prices. And what we're seeing in both the hull and machinery markets and the cargo markets at the moment is that this is what does appear to be happening. Underwriters tend to keep their pricing pretty much commercial in confidence, but brokers have got more of an incentive to blab, and they claim, and I've got underwriters to admit it in private, that they're driving quite big discounts, especially for new business, but also for incumbent business. Good brokers claim to be able to bring down your bills for hull and machinery insurance by about 10% on last year, and that seems to be borne out by anecdotal evidence that, to the best that we can work it out from the outside.
Should I be worried about extra capacity if I were a hull and machinery underwriter?
Well, hull and machinery has got a long history as one of the Cinderella classes in all of insurance, basically. I remember being very surprised when I first started writing about insurance and finding out the basics of it, that hull and machinery insurance as a market hadn't been profitable for something like 20 years. People kept in the business despite losing money. Where the turning point came was at the end of the last decade, when Lloyd's launched a program called Decel 10, which was effectively a purge of underperformers. The worst performing books were driven out. That boosted profitability to the point where it's been quite decent in recent years. In fact, as some brokers see it, it's easy money right now. Again, as you would expect from textbook economics, that has attracted in the new capacity. I mean, I guess these things just find their level. So long as it's broadly profitable, people are going to be happy. I mean, margins probably could come down a little. What we don't want to get is to the point where capacity drains away and prices do become much higher for ship owners.
That's where we're going to leave it this week. If you want to stay on top of all of the latest news and gossip from the marine insurance sector, there really is nobody better in the business than David Osler. You can read all of his work in the Lloyd's List app, where you can also listen to every episode of this podcast too. Normal service is resuming next week. We're back to our Monday slot, and we're also back to decarbonisation next week too, this time discussing the changing momentum in the future fuels race. But we'll be bringing you episodes from every corner of the industry in 2025, keeping you up to date with the stories shaping shipping. But for now, thank you to David for his insight, and thank you to you, of course, for listening. We'll speak to you next week. Goodbye.